Scott Riley at the Market Update Desk. It is January 4th, and we're starting today out with a bang, both in the market and with some fantastic news with mortgage programs and rates. So today we had the ADP uh, jobs report come out, and that refers to private payrolls, not government at all. And what it showed is that private payrolls increased by 164,000 jobs last month. Now, this was a significant increase from what the downward revision was last month, 101,000. Um, this is showing specifically a rebound in the hospitality and leisure section, and that sector added 59,000 jobs. Construction contributed 24,000 of those gains. There were only a few categories that were down on the month, which were manufacturing, which was off 13,000, and information services and natural services and mining both saw a decline of over 2,000 jobs. From a size perspective, companies with fewer than 50 employees led the way with job growth at 74,000 new jobs, which is fantastic. Small businesses leading the way. Geographically, the West had the biggest increase of 109,000 jobs added, while the Northeast added a healthy 94,000 jobs. The pace of earnings decelerated again, with those staying on their jobs seeing an increase of annual pay of about 5.4%, while job changers showed an increase of 8%. Now, this is what the ADP CEO quoted. We're returning to a labor market that's very much aligned with pre-pandemic hiring. And that's from the ADP chief economist, Nella Richardson. Also indicated while wages didn't drive the recent bout of inflation, now that pay growth has retreated, any risk of wage price spikes has all but disappeared. This is fantastic news as far as wage growth. It tells the Fed what they want to hear, that wage pressure is declining. Now, the higher than expected job growth in ADP was unexpected. We were actually anticipating a miss on job growth, so this was a little unexpected. And with these job reports, they can vary one way or the other, as what we've seen over the last 12 months. Initial jobless claims. That was for the week ending December 30th, totaled 202,000. That's a drop of 18,000 jobs. I'm sorry, drop of 18,000 initial claims from the previous period, and continuing claims, which were on a week behind, fell to 1.855 million, which is a drop of 31,000. So we showed a little bit stronger than expected job creation, better than expected initial claims, continuing claims, but we showed a decline in wage pressure. So we kind of had a teeter-totter effect there. The other report came out today was the Challenger job cuts report. A couple things from that. US-based employers announced 34,817 cuts in December. That's down 24% from the 45,000 plus cuts that were announced in November, and 20% from the prior month. So interesting. We showed an overall healthier job market than expected. Now this will play into what the Fed wants to do going forward, because they actually wanted to see job growth slack and unemployment go up a little bit. So this is a little bit of an interesting dilemma for the Fed. One of the things the Challenger job cuts report indicated was layoffs had begun to level off, and hiring has remained steady as we end 2023. Labor costs are high. Employers are still extremely cautious and in cost-cutting mode ahead of 2024. So the hiring process will likely slow for many job seekers, and cuts will continue in Q1 of 2024, though at a slower pace. That was from Andy Challenger, who is the head of Challenger Jobs Report. So some very interesting information there. One thing that we're still seeing within the financial markets is a little bit of an increase again in oil, This is due to the continued volatility and attacks that are happening in the Red Sea, that very, very important shipping lane that goes through there. It is causing dramatic effects to to how goods are moved internationally and adding to the shipping cost because many companies are diverting and going around the Horn of Africa, which adds time and expense. So the United States and many other countries are putting together a task force militarily to try to safeguard this very critical shipping infrastructure area. And that's an ongoing issue that we're keeping an eye on as increased oil prices can cascade down into increased inflationary costs. Now, we're seeing today the 10-year bond is up to about 3.982 right now. We're getting close and we're hitting that very important level of resistance at 4%, 4.02 area. We want to stay in the channel of where we're at. Ideally, we continue to stay in that path channel for 10-year bonds and mortgage-backed securities so that we can keep sustained betterment to mortgage rates. As we go forward, these job numbers are going to be very critical and inflationary numbers. Now, tomorrow, we get the BLS jobs report, which is going to be very, very important. Um, Hopefully, we won't see any volatility. Hopefully, it comes in at least at expectations, if not less. We'll keep you updated as that information comes out. One last thing today, just about 5 minutes ago, MSHDA announced a decrease to their down payment assistance program and their below market interest rate program. This is fantastic news for buyers as this helps them qualify for more. As one of the experts in the industry in MSHDA, happy to go over those any questions you may have on that and how that program can benefit you. Give us a call, 616-293-2189. Look forward to any questions you may have and have a wonderful day.